Stop what you're doing. Seriously, if you own any consumer discretionary stocks right now, you need to hear this. Last week, I decided to run Madison Square Garden Entertainment, ticker symbol MSGE, through 5 rigorous valuation models and 2 legendary investor checklists. And honestly, what I found completely shocked me. Now, I know exactly what you're probably thinking because I hear this fear from retail investors literally all the time. You're thinking, buying a cyclical, live event leisure stock right before a potential macro recession, with inflation squeezing everyone's wallets, that is basically financial suicide, right? You're supposed to just hide in safe utility stocks when the market gets shaky.
Well, consider this incredibly staggering number, 224.1%. That is MSGE's current return on equity. Just let that sink in for a second. Over 200%. This so-called cyclical leisure trap is actually blowing most high-flying tech darlings completely out of the water when it comes to raw capital efficiency. They are turning every single dollar of equity into massive returns, completely flipping that whole recession fear narrative right on its head.
But that brings us to a really massive multi-billion-dollar question. Is a world-class experiential moat actually enough to justify a trailing PE ratio hovering right around 69? Think about it like this. Owning shares in MSGE isn't just owning a building. It's like owning the monopoly toll booth to New York City's cultural heartbeat. Every time a major artist tours or a family wants that classic holiday trip, they literally have to pay your toll. But at what price does that toll booth become dangerously overvalued? Well, by the end of this explainer, you are going to know definitively if this stock is a screaming Warren Buffett buy or a highly dangerous Peter Lynch value trap. I'm going to give you a clear, actionable valuation framework that you can steal and apply to your own portfolio today. We are going way beyond the surface level numbers here. So let's dive into this ultimate valuation gauntlet. Section 1, the unreplicable experiential moat. Before we even touch the financial ratios, we really need to understand the sheer physical assets that are driving this entire business. We are looking at the world's most famous arena. It sits right on top of Penn Station in Manhattan, packing a maximum capacity of roughly 21,000 seats. It's actually the number 3 grossing venue of its size in the entire world. And here's the crazy part. You literally cannot replicate this portfolio. Why? Because there is simply no more space to build something like this in the center of New York City. The competitive supply is permanently capped. A competitor can't just come along and spin up a rival arena across the street. And it gets better, because they don't just rent out the building, they own the proprietary productions inside it. This brilliantly taps into Peter Lynch's invest in what you know concept. On one side, you've got the legendary Billy Joel residency, which is just an absolute staple of the city's music scene. On the other side, the Radio City Rockettes. Their Christmas spectacular is a 90-plus year tradition. Get this, it recently sold a record 1.2 million tickets across 215 shows in just a single season. That is wholly owned intellectual property driving massive, predictable, recurring attendance year after year. So the crucial takeaway here is that MSGE's physical backbone isn't just one single building. It relies on 5 iconic venues across New York and Chicago. In fiscal 2025 alone, these interconnected stages hosted over 975 live events and welcomed nearly 6 million guests. I mean, that sheer scale is the impenetrable foundation of their economic moat. It creates this massive network effect where top-tier talent essentially has to route their tours through MSGE properties. Section 2, unpacking the financial engine. Okay, so we need to see how those 6 million guests actually translate into cash flow. Just look at this incredible metric, 94%. That is their season ticket renewal rate for the 2025 to 2026 season. Think about that. If you are genuinely worried about a consumer slowdown, a 94% renewal rate proves an exceptionally deep audience connection. You simply do not get that kind of loyalty without offering a premium, highly demanded experience. People are literally prioritizing this over other discretionary expenses. And those loyal fans, they are driving some really massive fundamental numbers. Trailing 12-month revenue sits at $1.01 billion, which is up a very healthy 12.9% year over year. But I want you to pay close attention to that 47.5% gross margin. In a capital-intensive leisure segment, a margin that high reflects incredible pricing power. Furthermore, they're generating $329 million in free cash flow, which gives us a very attractive free cash flow yield of 9.37%. So they aren't just selling out arenas. They are highly efficient at turning ticket sales, sponsorships, and concessions into cold, hard cash.
Section 3, the 5 valuation models.
All right, here is the actionable framework I promised you. I really want you to focus on the contrast in this table. If you only look at the top line, a current trailing PE ratio of roughly 69 looks terrifyingly overvalued. I mean, it looks like a bubble. But look down at the price-to-free cash flow ratio. It's sitting at just 10.67. So why the massive difference? Well, it's because of high depreciation on their physical, world-class assets. That technically depresses their earnings on paper, making the PE ratio highly misleading. When you value MSG based on the actual cash it generates, it looks significantly cheaper. Plus, an ROIC, return on invested capital, of over 32% shows management is exceptionally good at allocating that incoming capital to generate even more returns.
And how exactly are they maintaining that capital efficiency? By strategically changing their business model. Management's stated goal is to move away from unpredictable event-to-event volatility. By securing those multi-year artist residencies we talked about, they are essentially building a recurring base of business. They're actively trying to transform volatile one-off ticket sales into stable, subscription-like economics extending into 2028 and beyond. And that drastically lowers their revenue risk profile.
Section 4, Buffett and Lynch checklists. So how does MSGE's data hold up against the greatest investors of all time? Taking through Warren Buffett's economic moat checklist, MSGE passes his strictest criteria with absolute flying colors. Do they have an unreplicable economic moat? Yes, that prime Manhattan real estate simply cannot be duplicated. Do they have consistently high return on equity? Yes, a staggering 224.1%. Do they generate strong free cash flow? Yes, $329 million of it. And do they have pricing power? That 47.5% gross margin confirms that they absolutely do. It really fits the classic Buffett model of a wonderful business at a fair price. Now let's apply Peter Lynch's criteria. Lynch focuses heavily on macro consumer trends and investing in what you know. Right now, we're seeing a massive shift in consumer behavior. People, especially younger demographics, are overwhelmingly prioritizing live, unforgettable experiences over physical material goods. MSGE is perfectly positioned at the exact intersection of post-pandemic venue scarcity and surging experiential demand. If you've tried to buy a concert ticket recently, you know exactly what Lynch would be looking at here.
But to be a good analyst, we have to look impartially at both sides of the coin. The bull case points to irreplaceable, premium experiential assets that clearly command a 94% renewal rate and a 13% revenue growth clip. That's fantastic. But the bear case is very real too. This is still a consumer discretionary stock with extreme sensitivity to macroeconomic downturns. If a global recession hits hard enough, leisure spending will eventually drop. Plus, for income investors looking for yield, they currently offer zero dividend payouts. They're choosing instead to reinvest that cash flow back into growth and share repurchases.
Section 5, the final investment verdict. Synthesizing all these valuation models and our GRU checklist, let's bring this explainer home. What you're looking at is MSG's official mission statement. But honestly, it is not just corporate marketing fluff. It is the exact operating model that justifies their premium Manhattan pricing. You simply cannot charge top dollar for a forgettable experience. Their commitment to deep audience connection is the exact engine driving their high margins and their incredibly high retention. Following their spinoff from MSG Sports, MSG has really evolved into a highly focused, capital-efficient, pure play. They aren't distracted by sports team ownership anymore, which, let's face it, carries its own unique set of financial burdens. They are now solely focused on live entertainment, perfectly poised to benefit from the direct artist-to-fan relationship through their residency models and flagship productions. They know their lane, and they are dominating it. Which leaves us with one final vital question for you to consider in your own analysis. If a severe macro recession actually hits, does that incredible 94% season ticket renewal rate finally break? Or, because there will never be another Madison Square Garden built in Manhattan, is the terminal multiple on this irreplaceable cultural monopoly essentially infinite? Think about how that fits into your own portfolio strategy.